All right, guys, let's start. Okay. So today we are doing another topic, right? So we are now starting with your liquidity and treasury risk, right? So again, first topic, easy topic, not difficult. We're starting with book 4 of your FRM part 2, right? Which focuses on your liquidity and treasury risk. In this chapter, we are specifically studying your liquidity risk, right? Now, first, please understand, right? One thing, liquidity risk is one of the most important risks in your financial markets. Why? Because many institutions fail not, again, I'm repeating, many institutions fail not due to your insolvency, but due to your lack of liquidity, right? This chapter is subdivided into your 3 modules. Module 1 is about your trading liquidity risk. Module 2 is about your funding liquidity risk. Module 3 is about your liquidity, black holes, and positive feedback trading. We start with your module 1, which focuses on your trading liquidity. What does trading liquidity means? It means the ability to sell your assets in the markets without causing your large price movements, right? That's what we want to understand. Okay, so let's get started, guys. That's what we are here to do. And this is a tricky topic. Try to understand, right? All right. So now, when we go into your trading liquidity risk, right, please understand in this module, we will cover your 6 important topics. Topic 1 is about your introduction to liquidity. Topic 2 is about your market price conventions. Topic 3 is about your cost of liquidation. Topic 5, 6, and 4 are given. 4 is your liquidity, VAR, LVAR, and your positions, unwinding speeds. Topic 5 is about your cost of liquidation, example, normal market. Topic 6 is about cost of liquidation, example, your stress market. The structure is very, very logical. First, we understand what liquidity means. Then we understand how prices are quoted in your markets. Then we calculate the cost of liquidity positions, liquidating your positions. And finally, we see how this affects your risk measurements, right? So that's what we are trying to do. Okay. Not too difficult till now. Try to understand. Okay. All right. Now here we are talking about introduction to liquidity. Now, please understand that first of all, we should try to understand the difference between liquidity and solvency, right? Solvency, as it given, asset exceeds your liability, positive equity, right? So solvency means that asset exceeds your liability. In simple terms, the company has positive equity. Liquidity is different. Liquidity means the ability of the company to meet its obligation as they come due, right? So very important difference here. Solvency is about your long-term financial health. Liquidity is about your short-term cash availability. A firm can be solvent, but illiquid, right? For example, a bank may have your valuable long-term loans as your assets, but if your depositors withdraw your money today and the bank cannot quickly sell those loans, the bank faces your liquidity problems, right? Now, let's go and talk about your trading liquidity. When we talk about trading liquidity refers to the ease with which an investment can be sold. If an asset can be sold quickly in large quantity without significantly affecting its price, it is highly, highly liquid, right? Examples of high liquidity are large publicly traded equity securities. Examples of low liquidity are non-investment grade debt, emerging market equities. Now, please understand the sale price depends on 4 things. First, estimated value, which is the mid-market price. Second, speed of sale. Third, quantity being sold. Fourth, overall economic development. And if you sell quickly or in large quantity, you will push the price against yourself. Finally, you have your predatory trading. Predatory trading means that when your market participants know that another entity must liquidate a large position, they execute similar trades to profit, which drive the price against the liquidating entity. This increases your liquidity risk significantly. Okay, keep that in mind. Points are given here very clearly, right? Market participant execute similar trades to profit, knowing other Another entity needs to liquidate a large position, driving the price against the liquidity entity. Sale price is a function of estimated value, speed of sale, quantity being sold, overall economic environment. High liquidity, low liquidity has been given, solvency versus liquidity difference has been given, right? So everything given in the slide, don't worry, please keep noting down, right? Then we talk about the market price convention. Now let's try to understand how prices are quoted in your financial market, right? There are three important prices. One is your bid price. This is the price at which the asset is sold. It is the lower value. Then we have the offer price. This is the price at which the asset is purchased. It is the higher value. Then we have the mid-market price. This is the fair price halfway between the bid and the offer. The difference between the bid and the offer is called the spread. Spread increases with your order size. Now we have two types of spreads. First, proportional bid-offer spread. It is calculated as your offer price minus your bid price divided by your mid-market price. Second is the dollar bid-offer spread. It is simply offer price minus your bid price. The dollar spread tells us the absolute cost. The proportional spread tells us the relative cost, right? So keep that in mind. What are different types of spread and what does each spread tells us? The dollar spread tells us the absolute cost. The proportional spread tells us the relative cost, right? And dollar bid offer spread, how do we calculate? Offer price minus bid price, right? And proportional bid offer spread, how do we calculate given offer price minus bid price divided by mid-market price? Okay, so remember that. Then we go ahead, guys. Then we move to the cost of liquidation, right? Now, when you talk about the cost of liquidation, please understand when we calculate the cost of liquidation, first in a normal market, the cost of liquidation is equal to the sum of your proportional spread multiplied by the dollar value of the position divided by 2, right? So proportional spread multiplied by the dollar value of the position divided by 2, right? Here, please note that alpha represents the mid-market or dollar value of the position. Why are we dividing by 2? Because when you sell, you typically lose half the spread related to the mid price. Now, when you look at your stress market, in stress market, spreads are uncertain and wider. The cost of liquidation becomes your sum of your mu plus your gamma times your sigma multiplied by alpha divided by 2. Here, what is happening in the stress market? Please note, right? Mu represents the mean proportional spread. Sigma represents the standard deviation of the proportional spread. Gamma is the confidence level, which is the Z-score. For example, we will have 1.645 for your 95%. Alpha is the mid-market value of the position. And this formula assumes that the spread follows a normal distribution. There is strong positive correlation between assets during your stress. And important thing to realize, right? Important intuition to take away is that in stress, spreads widen and move together. Overall, what we need to understand is that larger positions create more liquidity risk because they widen the bid-offer spread, therefore setting the trade size limits, and holding your smaller position reduces your trading liquidity risk, right? So that's what we need to keep in mind. Okay. All right. Okay. Now we go into your next slide, which is your cost of liquidation. Example is the normal market. When we try to apply the normal market cost of liquidation formula using a numerical example, we are given two positions, right? First position is your 2 million shares of ABC company, where the bid price is 25.50, the offer price is 27. Then we have the second position, which is the 500,000 shares of XYZ company, bid price is 45, offer price is 46.50. And we are asked to calculate three things. One is the mid-market value of each position. Then we have proportional bid-offer spread, right? And the cost of liquidation in the normal market. Now, how do we go about it, right? See, when you take the ABC, right? First part, ABC. First, we do the offer minus bid, right? 27 minus your 25.50 is 1.50. Same thing we do for XYZ, 46.50 minus 45 gives us 1.50. So both stocks have the same dollar spread of your 1.50, bid offer spread of 1.50. Then you calculate the mid-market price. For ABC, it is 25.50 plus 27 divided by 2. That gives us 26.25. Then 45 plus 46.5 divided by 2, 45.75. And you calculate the mid-market value. For ABC, it is 26.25 multiplied by your 2 million shares. We get your $52.5 million, right? This is what we get. For XYZ, 45.75 into $500,000 shares, we get 22.875, right? $22.875 million, right? Now, you calculate the proportional spread divided by your mid price, 1.50 divided by 26.25, get 0.05714. 1.50 divided by 45.75, 0.03279. You have to notice that even though the dollar spreads are equal, right? The proportional spreads are very different. Dollar spreads were 1.50 only. The proportional spread is very different, 0.05714, 0.03279. Right? So ABC is relatively less liquid than your XYZ because the spread is wider. Then we calculate the cost of liquidation in the normal market. So cost equals the proportional spread, right? Proportional spread into your mid value, right? Divided by 2, right? So for ABC, it is 52.5 million into your 0.05714 divided by 2. Total cost in this case, before we go to total cost, we have to take your XYZ also. 22.875 million into 0.03279 divided by 2, we get the $1,874,961. This is the liquidity cost in a normal market. We lose half the spread relative to the mid price when you are liquidating, right? We lose half the spread, right? Relative to the mid price when we are liquidating, right? That is the point we are getting here. Very, very important. Okay. So that's the idea we are getting. Okay. Then we go ahead. Now we have stress market. When we move to a stressed market, in stress market, spreads are not fixed. They are random, they are volatile. We are told that the mean spread is equal to 1.5, standard deviation is equal to 2.5. We calculate cost at your 95% confidence level. The Z-score is 1.645. Mean and standard deviation are given. First is convert to your proportional terms, right? How do you convert for ABC? Mean proportional spread is equal to 1.5 divided by 26.25, 0.05714, which we have done earlier also, and 0.03279, which we have done for XYZ also earlier, right? Then when we look at the standard deviation proportional bid offer spread, you 2.5 divided by 26.25, 0.09524, 2.5 divided by 45.75, 0.05464. Then you apply the stress formula. Stress formula is equal to mean. Mean is equal to what? What will you do in the mean? You have the 52.5 million, when you are calculating the stress cost, mean plus 1.645 into deviation. So 52.5 million into your 0.05714 plus 1.645 into 0.924 divided by 2. Same thing here, right? You get the value 7015,577. Please note here that normal market cost was about 1.87 million. Stress market cost is about 7.02 million. So liquidity risk explodes in stress, right? That is what we need to understand very, very clearly. See the number which is different in both cases. Okay. The first case was your 1.87 and next case was 7.02. Okay. Then we go into practice question, right? Regus Bank owns 5 million of a stock with a bid price of 10.50 and offer price of 12.75. The cost of liquidation in normal market condition is closest to what? Right. So Regus Bank owns 5 million shares, bid price 20.5 and 12.75. We need cost of liquidation in normal market condition. So mid price will be 10.5 plus 12.75 divided by 2. So it gives me 11.625, right? And then 11.625 we get, right? You will multiply with the number of shares, right? So what will you do is, first step is, step number 1, you will do 10.5 plus 12.75 divided by 2, you get your 11.625. This is your mid price, right? Then you have to find the mid market value, right? So you have 11.625 multiplied by 5 million, right? 5 into 10 raised to the power 6. This gives me value of $58.125 million, right? And then we have to find third step, which is your dollar spread, right? Dollar spread, when I try to find out, right, it is what? 12.75 minus 10.50, which gives me 2.25, right? Then we find out the proportional spread. Proportional spread is 2.25 divided by your what? 11.625, which we got here, right? So this came out to as 0.193548, right? So this is what we have. And then we have to find the cost of liquidation, right? Then we have to find the cost of liquidation, right? So cost of liquidation, right, is 58.125, right? Then you multiply that 58.125 with what, right? Is equal to 0.193, right? 548, right? Divided by 2, right? So this is the proportional spread we have taken, right? This is the proportional spread we have taken, right? So we divide by 2. So what do we value we get? We get 5.625. This is the answer, guys. So it is 5 step, 1, 2, 3, 4, and your 5th, right? So 5-step procedure. First you find the mid price, then you find the mid market value, then you find the dollar spread, then you find the proportional spread, then you multiply the mid market value with the proportional spread divided by 2, right? That's what we get. In normal market, cost equals mid value into proportional spread divided by 2. Mid market value into proportional spread divided by 2. Okay, that is what we are doing. And that's what the question. So go back, practice it, right? That's what we got the answer. The same thing has been done here, right? So understand it very clearly. Okay. Then we go ahead, then we talk about your liquidity war, which is L war, and positions unwinding speeds, right? See, liquidity war and positions unwinding speed. Please understand that now we are extending the concept to your risk measurement, right? We understand traditional war measures your market risk only. It assumes you can liquidate at your mid prices, but that is quite unrealistic, right? Because obviously in liquidity, in the stress environment, liquidity kinds of evaporates. So we introduced another concept called liquidity war, right? What is liquidity war? By definition, liquidity war estimates that value at risk while explicitly taking into account the cost of unwinding positions. In simple words is liquidity war is equal to market risk plus your liquidity cost, right? Market risk plus your liquidity cost, right? And when we take the LVR, normally it is again your what is happening here is you have normal war plus the normal market cost of liquidation, which is war plus sum of your proportional spread times your position value divided by 2. And when we take the LVR, liquidity war in the stress market, is war plus your stress liquidation cost, right? which uses your mean plus your gamma times your standard deviation, the whole thing multiplied by alpha divided by 2, right? So liquidity risk increases your total risk, right, which we are getting. And then we have the trader's liquidation decision, which is very, very important point you have to understand. It's a very important trade-off. If a trader unwinds very quickly, market risk kind of reduces because exposure time reduces. But liquidity risk kind of increases because spreads widen for your large immediate trades. If trader unwinds slowly, market risk increases because price may move against you, but liquidity cost decreases because you avoid large spread impact. So there is a trade-off, right? There is a trade-off between market risk and liquidity risk. So what's the trader's objective? Trader's objective is to minimize your total VaR, which includes market variance term plus your liquidity cost term. The objective function shows both risks which are combined. So optimal liquidation speed balances your price risk and the spread risk, which is what is given here. That is the core intuition of liquidity VaR, right? So that's the objective also, which has been highlighted very, very clearly, and this you have to understand. Okay, very clearly. All right. With this, we have completed the module 1, right? Now we are going into module 2. Module 2 is about your funding liquidity risk, right? Now, once we have completed module 1, we move from your trading liquidity risk to your funding liquidity risk. In module 1, we studied your how difficult it is to sell asset without affecting your price. In module 2, we shift our focus. Here the question is, can the firm obtain cash when it needs it, right? So that's what we are trying to do. There are 5 topics here. Topic 1 is what is the funding liquidity risk. Topic 2 is sources of liquidity. Topic 3 is case study. Topic 4 is liquidity risk ratio. Topic 5 is BI's principle for sound liquidity risk management. So remember, module 1 is selling assets. Module 2 is raising your funding. That's what we are trying to understand here. Okay. All right. Then we go to your funding liquidity risk. So funding liquidity risk is defined as a measure of a firm's ability to meet its cash need as they come due. In simple words, can the firm acquire your funding when required? And let us look at the key causes of funding liquidity risk, right? So first is your weak financial performance. If a firm performs poorly, investors lose your confidence, leaders demand higher rates, funding becomes expensive or unavailable. So profitability directly affects the liquidity. Then you have liquidity stresses and your hesitant investors. In stress market, investors become cautious, funding dries up, banks stop lending to each other. Even a healthy firm may face funding difficulty. This is a systematic risk. Then you have the funding mismatches, which is a very important concept because funding mismatches occurs when short-term instruments are used to fund your long-term assets, using your overnight borrowing to fund your 10-year loans. If short-term funding is not rolled over, the firm faces crisis. And this is your maturity transformation risk. Then we have the predictability of obligations. Some obligations are predictable. Example, your coupon payment in bonds. This can be planned. Other obligations are kind of unpredictable. Example, your customer withdrawals. If many depositors withdraw at once, right, liquidity pressure kind of increases. So funding liquidity risk depends on how predictable the cash flow are. Okay, so that's what we need to understand. All right. Then we move ahead to sources of liquidity, right? So a financial institution has 6 primary sources of liquidity, right? So let us go one by one through them, right? One is your cash and treasuries. These are safe and highly liquid instruments. Example is US Treasury securities, UK government bonds. This can be quickly sold or repoed, but trade-off is that they are low return. So banks must balance liquidity and profitability. Then we have retail and wholesale deposits. These are funds from customers. Retail deposits are usually more stable than your wholesale deposits. However, customers can move fund if better interest rates are available. So deposits are somewhat unstable. Digital banking has increased the mobility of your funds. Then we have trading book liquidation. A bank can sell part of a trading book for cash, but success depends on how liquid the assets are. In your stress market, buyers disappears, prices collapse, liquidation becomes ineffective. So this source is unreliable during your crisis. Then we have securitization, pooling your illiquid assets like your loans, selling them as securities. This converts your illiquid loans into tradable instruments. However, the strategy collapsed in late 2007 during the subprime crisis. So securitization works in your normal markets but fails in stress. Then we have the borrowing ability, which is the banks can borrow via your loans, lines of credit, but in stress market, interest rates kind of increases, maturities kind of shorten. So funding becomes expensive and kind of unstable, right? So stress market things changes. Then finally, we have central bank borrowing. Central bank act as lender of last resort. Federal Bank, your European Central Bank, your Bank of England, but this comes with trade-off. Trade-off is high collateral requirements, haircuts, negative market signal. If a bank borrows from the central bank, the market may perceive weakness. So this is emergency funding, right, which we have to understand. Okay. Now, with this understanding, let's go to next part, which is your questions. Which of the following statements accurately reflects your liquidity management for a financial institution, right? So the question is asking which statement accurately reflects your liquidity management for a financial institution. We look at option A, investments in treasuries, securities help a bank increase its risk and return profile. See, it's not correct. Reason is that treasuries reduce your risk, but also reduce return. They improve liquidity, but not your risk return enhancement, right? We look at option B, that is also wrong. Stability in retail deposits over the year has enhanced bank liquidity, right? Incorrect, retail deposits have become less stable due to ease of fund transfer. Then we have option C, which is your central bank borrowings are relatively cheap ways for banks to stay afloat. Again, wrong. Central bank funding is costly and send a very negative signal. Then we have option D, stressed markets can limit the effectiveness of trading book liquidation strategies. Yes, right? Liquidation kind of disappears, prices fall sharply, asset sales may not generate expected cash. Therefore, the correct answer is D, right? Which is very important to understand. Liquidity sources that work in normal market may fail in the stress. Funding liquidity risk is highly state dependent, right? So that we need to understand. Okay. All right. This is what we have, right? Same thing, guys. I've explained the same thing. Going ahead. Now we have the case studies, right? When we say the case studies, right, what we have to understand here is that we'll try to study real world case studies. Case studies are extremely important because they show how your liquidity risk actually destroys the institution. Liquidity problems usually start small, but under your stress, they escalate very quickly. First case was your Northern Rock, 2007-9. Background was Northern Rock was a British bank heavily involved in your mortgage lending, but the problem was that it relied heavily on short-term debt to fund your long-term mortgage assets. So it had a maturity mismatch. The crisis was that after the US subprime crisis, investors became reluctant to lend to your banks. Wholesale funding market froze. Northern Bank could not roll over its short-term funding. The bank approached the Bank of England for emergency funding. When this became public, depositors panicked. A massive bank run occurred. £2 billion were withdrawn in 1 week. The outcome was that emergency borrowing reached £25 billion. Eventually, the bank was nationalized. The biggest lesson here was that short-term liabilities funding long-term assets is extremely dangerous during stress. Funding mismatches are manageable in normal time. They are fatal in crisis. Okay. Next one was Ashanti Goldfields, 1999. Ashanti was a gold mining company. It sold gold forward, meaning it took your short positions to hedge against your price declines. The crisis which happened was central bank limited your gold sales, gold demand kind of surged, gold price jumped over 25%. The failure was Ashanti's short position triggered massive margin calls. Margin call required immediate cash. So the company's underlying asset, gold mines, were illiquid. They could not be quickly converted to cash. Outcome was that company was forced to restructure its old asset and diluted equity, right? So the lesson was that illiquidity of underlying asset was misaligned with the immediate need for cash to meet margin call. liquidity timing mismatch is as dangerous as your maturity mismatch. Okay, that we need to understand. Okay. Then we go to another case study, which is you have studied in your FRM part 1 also, MGRM, Metal Gun Shaft, MG 1993. MG was a German conglomerate. It sold long-term fixed price oil supply contracts for 5 to 10 years. To hedge this, it used short-term future contract. This strategy is called your stack and roll hedging. Oil prices fell sharply. The crisis was brewing. The short-term future required large immediate margin payment. This created an imminent cash drain. Management closed out both the supply contracts and the hedge. This led to losses exceeding $1.3 billion. Again, the same problem. Immediate cash outflows from your margin calls did not match the timing of cash flow from your long-term contracts. Liquidity timing risk destroyed the firm, right? So that's what is another lesson. Okay. Once we have understood these three case studies, now we are going to next topic, which is your liquidity risk ratios. After the 2007 financial crisis, Basel III introduced two major liquidity ratios, LCR, liquidity coverage ratio, NSFR, net stable funding ratio. These are two regulatory requirements. Liquidity coverage ratio is the LCR ensures that the bank has enough HQLA, high quality liquid assets called HQLA, to survive a severe 30-day stress scenario. The formula for LCR is high quality liquid asset divided by your net cash outflows over 30 days. This must be greater than or equal to 100%. What is included in your stress scenario? The 30-day stress assumes 100% loss of your wholesale funding, line of credit drawdowns, partial loss of your deposits, 3-notch downgrade in credit ratings, higher haircuts on secured funding. This is severe but plausible stress. The bank must survive 30 days without your external help, right? Then the next one is your net stable funding ratio. NSFR ensures that long-term assets are funded with sufficiently stable funding sources. It addresses your structural, your security mismatch. NSFR formula is available stable funding divided by your required stable funding. It must be equal to or must be greater than or equal to 100%, which is given very clearly. Available stable funding comes from your long-term debt and your sticky deposits. Required stable funding depends on the liquidity characteristic of assets and off-balance sheet exposure. So LCR is a short-term survival, NSFR is a long-term structural stability. That's what we need to understand. Okay. Then we go into your practice question 2. Which of the following factors must be taken into account in the net cash outflow in 30-day period component of the liquidity coverage ratio as required by the Basel III? See, option A, when we see complete losses on deposits, again, this is incorrect. The reason is Basel assumes partial loss of deposits, not your complete loss. Option B, partial losses of wholesale funding, and again incorrect because Basel assumes 100% loss of wholesale funding, right? Wholesale funding moves faster. Option C, your larger haircuts on your secure lending, correct, right? Stress scenarios include your higher haircuts. Option D, 2-notch reduction in credit rating, wrong. Basel assumes a 3-notch downgrade, therefore the correct answer is option C. Okay. All right, so this is given correctly. Then we have the BIS principle for your sound liquidity risk management. See, after the crisis, the Bank for International Settlements developed 17 principles for sound liquidity risk management. These principles are grouped into your governance, your measurement, your stress testing, and your supervision. Governance and strategy, you look at the fundamental principle, bank must have a comprehensive liquidity risk management framework. They must maintain sufficient unencumbered liquid assets to withstand your stress. Unencumbered means not judged as your collateral, not pledged as collateral. Then look at the risk tolerance. Liquidity risk tolerance must align with the bank's business model. For example, an investment and retail bank have different liquidity profiles. Then look at the board responsibility. The board must approve liquidity strategies and policies at least annually. Senior management must implement them effectively. Liquidity is not just a treasury job, it's a governance issue. Okay, then we have the pricing and performance. Liquidity costs and risks must be incorporated into your internal pricing. your performance measurement, your new product approval. Liquidity must be priced into your business decision, right? That must be kept in mind. Okay. Then we go ahead, right? Then we go ahead. Then we move into your, again, okay, this is, we are moving into measurement and management and your stress testing and contingency. Cash flow projections, banks must project cash flows, inflows and outflows accurately. Without projection, liquidity risk cannot be managed. Then monitoring and control, liquidity exposure must be monitored across your business lines, your legal entities, your currencies. Liquidity problems can arise in one entity, even if the group looks stable. Then we have to have funding diversification. Banks must diversify your funding sources. Do not rely on one source. Strong relationship with funding providers are essential. And we also look at intraday liquidity. Banks must manage liquidity during the day. Payment system requires settlement even before end of day balances. Intraday failures can create your systematic risk, right? That's what we look at. Then we have your stress testing and contingency. Liquidity stress testing is very, very critical. You look at the collateral management. Banks must distinguish between encumbered assets which are pledged and unencumbered assets which are available. Only unencumbered assets provide true liquidity. When you look at the stress test, regular stress test must identify your vulnerabilities. Strategy must be adjusted based on your stress outcomes. Then look at your contingency funding plan, CFP, right? If formal plan must exist, it should clearly specify what actions will be taken, who is responsible, how funding gaps will be filled. This plan must be regularly tested. Then you look at the liquid assets. Bank must maintain a clearly identifiable portfolio of high quality, unencumbered liquid asset. These must be readily available without legal or regulatory constraints, right? Which is very, very important. Okay. Then after we have understood this, right, we go into your next point, which is your disclosures and supervisions. Finally, we look at the transparency and supervisions. Disclosure means regular public disclosure, allow market to assess liquidity strength. Transparency reduces panic. Supervisory assessment, regulator must comprehensively assess liquidity positions. Supervision is proactive, not reactive. Intervention, supervisor must be ready to intervene early if deficiencies appear. Early action prevents your systemic crisis. Communication, regular communication between supervisors and authorities is essential, especially during stress. Liquidity crisis spread quickly. Coordination prevents your contagion, right? That's what we need to understand. Okay. Then we go ahead. Okay. Then we move to your module 3, last but not the least. Module 3, we are looking at the liquidity black holes and positive feedback training. In this module, we study something extremely important. Liquidity does not always disappear randomly. Sometimes the market collapses because of trader behavior. This is where liquidity black holes and positive feedback trading comes in. So we should try to understand that, right? Liquidity black holes and trading behavior, right? And then reasons for positive feedback trading. Okay. Then let's go ahead, right? Let's talk about your liquidity black hole and trading behavior, right? So first, what is the liquidity black hole? A liquidity black hole occurs when market liquidity suddenly dries up because everyone wants to be on the same side of trade. Either everyone wants to buy or everyone wants to sell. This is called a crowded exit. The key idea here is when prices falls, investor panic, they rush to sell. But if everyone wants to sell, who's buying? Liquidity kinds of disappear, price collapse far below your intrinsic value. This is not always about fundamental. This is about your imbalance. Then there are different trader types. There are two types of trader. One is the positive feedback trader. One is the negative feedback traders, right? Then if you look at the negative feedback traders, these are contrarian traders. They buy when prices fall. They sell when their prices rise. They stabilize market. They provide liquidity during stress. Positive feedback traders, they are momentum traders. They buy when prices sell. Or they buy when prices rise. They sell when prices fall. They amplify the trends. When they dominate, market becomes kind of unstable. So in liquid markets, negative feedback traders kind of dominate, right? And in crisis, positive feedback traders dominate. That is when your liquidity disappears, right? So that's what we have to understand. Okay. Then we go ahead. We talk about reasons for positive feedback trading. We try to analyze why positive feedback trading happens. So we have the stop loss rules, right? Automatically trigger your sales when prices fall below your predetermined levels. This purpose is to limit your losses, but the side effect is more selling when the prices falls. This amplify your downward momentum, right? Then we have the trend and breakout trading. Trend traders buy during your price increases and sell during your declines. Breakout traders act when price breaches certain technical levels. Both reinforce existing your price movements. This creates your self-reinforcing trend. Then we have the predatory trading, right? Some traders participate or anticipate that a large institution must sell. They short the asset in advance. This pushes prices down even further. They profit from the forced liquidation. Option hedging by a short seller. If an institution is in short calls, rising prices force them to buy the underlying asset. If they short puts, selling prices force them to sell. This is dynamic hedging. When many institutions hedge simultaneously, liquidity stress kind of increases, right? So that's what we have. Then we go into your next part. Next part is reason for your positive feedback training. We are still continuing with that feedback trading. One is the synthetic options and portfolio insurance. When you look at the 1987 crash, that is a classic example. Portfolio insurance strategies created synthetic puts using dynamic hedging. The rule was when buy when prices rise, sell when prices fall. That sounds protective, but when everyone followed this rule, it created a spiral. In October 1987, around $12 billion of required selling over 3 days overran markets. Only $4 billion was executed by Friday. The remaining selling pressure exploded on Monday. This is how Black Monday happened. Liquidity vanished because everyone was selling, right? Then we have something called margin calls. When investors use leverage, price declines, trigger margin calls. Margin calls require immediate cash. If they cannot provide cash, they must liquidate position. This forced selling accelerates your price decline. Again, positive feedback, right? Very, very important to understand, right? Then next is your leveraging and deleveraging cycles. What you should say is in good times, bank extend your credit quality, credit easily. More borrowing increases your asset demand. Asset prices rise. Rising price increases collateral value. This allows more borrowing. This is a leveraging cycle. Deleveraging in bad time, asset price fall, collateral value falls, bank tighten your lending. Investor must sell your asset, prices fall further. Leveraging spiral, the spiral creates liquidity black holes, right? That we understand, right? Then we move ahead. Then we have something called irrational exuberance and asset bubbles. Alan Greenspan used the term irrational exuberance in the 1990s. He questioned whether stock prices were justified by your fundamentals. Asset bubbles follow a reinforcing process. Price rises, profit increases, more investor enter, price rises further, risk become hidden. Housing bubble example, the same happened in the mid-2000 US housing market. Massive year-on-year gains attracted widespread participation until the bubble burst, right? Then we look at the regulatory uniformity and liquidity black holes. Uniform regulation can sometimes create systemic risk. If all institutions respond identically to stress, they all sell at the same time. That creates liquidity black holes. Banks, your pension funds, and insurance have different time horizon. If regulation forces them to behave the same way, market diversification disappears. Regulatory diversity can reduce your synchronized selling, right? That's what we understand. Then we have LTCM crisis 1998. Long-term capital management is a classic example. The hedge fund shorted liquid bonds and bought illiquid bonds. The trade deepened on spreads narrowing. Then Russia defaulted, spread widens instead, right? And the trade depended on your spreads narrowing. Because LTCM was highly leveraged, it could not meet your margin call. It was forced to liquidate. This forced selling widened your spreads further. The Federal Reserve coordinated a bailout to prevent systemic collapse. And then the leverage plus illiquidity plus margin call equal your systemic risk. Liquidity enters or liquidity crises are not just about your bad asset, they are about your feedback loops also, right? So that's what we need to understand, right? Overall, what have we done till here is in your model 3, liquidity black holes occur when everyone wants the same side of trade. Leverage forces your liquidation. Momentum trading dominates. Margin calls amplify price moves. Markets are kind of stable when your contrarians dominate, and market collapse when your momentum dominates, right? So that's what we have. Then the question here is that in a highly liquid market tends to result from a situation where right? There are four options. Option A, stop loss rules take effect as price decline, right? So that's not correct, right? Why? Because stop loss rule triggers your automatic selling when prices falls. This increases your selling pressure during declines. That reduces your liquidity. So this does not create a highly liquid market. Option B, negative feedback traders sell shares at price rise. This is correct because they sell when price rise, they buy when price fall. What does this do? When price rise, they provide selling supply. When price fall, they provide buying demand. This stabilizes your market. This increases your liquidity. This is correct. Positive feedback trader purchase share at price rise. Again, positive feedback traders follow momentum. They buy when price rise. They sell when price fall. They amplify trades, right? So this is not the correct answer. If prices are rising and they keep buying, volatility increase. This reduces your stability. This can create your liquidity stress. So this does not create your highly liquid market. So we are eliminating option C. Then breakout trading occurs because the price moves outside of range. Again, this builds on trend. It does not stabilize market. Breakout trading reinforces price momentum once the range is broken. It contributes to positive feedback effect. So this also does not create stable liquidity, right? So this also goes away, right? So answer is B, right? So very, very important to understand how this is tested in exam, right? And that completes our chapter. But you can remember that markets are most liquid when contrarian traders dominate, right? That's what we need to keep in mind. Let's have a quick recap, guys, here. See, this chapter, if we start from the first part, right? Trading liquidity risk, funding liquidity risk, and liquidity black holes and positive feedback trading. Right. So in this part, a lot of theory initially, introduction to liquidity, market price convention, but understand what is the proportional bid offer spread, dollar bid offer spread. Then once we understood this, then cost of liquidation, very important. Cost of liquidation, normal market, cost of liquidation, stress market. Remember the formula, very, very important. Right. This question, again, I did it directly, read the question properly, understand the data, right? Try to solve when you are free in your homework. 25.50, 27, 45, 46.50. This is a classic case where the question has been explained in utmost detail so the students can understand, right? The whole calculation there, you can go back and just do it on your own, you will understand, right? That this is the case when bank was owning 5 million shares exact. This is the case. The bank was owning 5 million shares. A bid was given, offer price was given. There are 5 steps here, 1, 2, 3, 4, and 5th step, right? So follow the sequence, find the mid price, then mid market value, then dollar spread, then proportional spread, cost of liquidation, then we find out. Please remember, cost of liquidation is mid market value into your proportional spread. So you have to find proportional spread and mid market value. How you do it, that's on you, right? Then we understand that we have done this. Then LVAR is very, very important. Liquidity war, what does signify? What is the formula in the normal market condition, stress market condition? And even the trader's objective also, that formula is very, very important, which is given, right? So these formulas are very important, 3 formulas, right? Then second is funding liquidity risk, then theory, lot of sources of liquidity, right? This is a little tricky. Which can limit the effectiveness of trading book liquidation, right? Then this case study, Northern Rock, Ashanti Goldfields, MG, your liquidity coverage ratio, net stable funding ratio, formulas, right? Very, very important. Then we have BIS, Principle for Sound Liquidity Risk Management, Governance and Strategy, right? What comes under that? Measurement and management, what comes under that? Stress testing and contingency, right? Then have your disclosure and supervision. Then we go to module 3, where we talk about liquidity, black holes, and trader behavior, right? We also talk about how does it affect, right? Positive feedback traders, negative feedback traders, stop loss rules, trend and breakout trading, predatory trading, option hedging by short sellers, right? We understood everything. Synthetic option and portfolio insurance, margin calls, leveraging and deleveraging cycles. Please understand all this. Irrational exuberance and asset bubble, regulatory uniformity and liquidity black holes, LTCM crisis. All these are very important. And then we have a question, right? So go back, study it, understand it, guys. Very, very important topic, right? Notes are with you. I've explained you well. Formulas are given in the slides. You just have to note down, practice the questions, go back, right? And that's it. That's it. You'll understand. Okay. So I'll stop here, guys. Go back, revise it, and I'll see you in the next lecture. Okay. Thank you.